Welcome to the Money Mastery Unleashed podcast. I'm your host, Adam Olson, and I got a super special guest with me today, David McKnight. David's an author, he's a speaker, he travels the country educating financial advisors and consumers. He's got a couple great books that I love: The Power of Zero, Tax-Free Income for Life. He also has a documentary that's out there on Amazon. If you just search The Power of Zero, you can find it on Amazon. I'll link David's website so you guys can find his books. He's been prominently featured on CNBC, Fox Business. He's been all over the media for the good news that he's spreading about the power of zero. David, how are you doing today?
Great. I'm here in sunny Puerto Rico, so I can't complain about the weather. Everything else is going well too. I appreciate you having me on.
Yeah, that's awesome. I'm really excited for this episode today because we're going to help so many people with the message that you share. So what I want to do today is I want to frame the problem that you speak so eloquently about, and then I want to go in some solutions, specifically the LIRP plan, life insurance retirement plan. You wrote a book on that as well that I want to touch base on some very important topics from that, David. But first, let's talk about the problem. You call it the tax freight train. We have issues with Medicare, issues with Social Security. The national debt is out of control. I kind of laugh sometimes because people complain about taxes now, and people like you and me kind of foresee what's going to happen in 2026 and 2030. So talk a little bit about this tax freight train that's headed our way so people are aware of what's coming.
Yeah, I think awareness is a big thing. A lot of people don't realize that taxes in the past have been dramatically higher than they are today. Post World War II was as high as 94%. Granted, you had different types of deductions and different types of tax brackets back then. But the point is, we've been sort of lulled into this false sense of security that taxes are low today. Although if you ask people if they're low, they'll say no. But they are historically low. If you ask them if taxes could go up, they say no. And why? Because taxes have been relatively low their entire lives. And when you pan back the camera and you look at the last 100 years, you realize that taxes during the 70s were as high as 70%. Taxes in the early 60s were as high as 89%. And like I said, in the 40s, they were as high as 94%. So taxes have ebbed and flowed over time based on the sort of the needs of our government. So the question becomes, are we marching into a future where the federal government is going to need huge infusions of cash? In other words, are we marching into a time period, which is sort of like in the wake of World War II or during the 70s, where the government is going to need more cash to be able to pay their bills? And the answer is overwhelmingly yes. And it's not my opinion. These are sort of the pure, hard, cold mathematical facts. We're past the point of no return in which the federal government will have to raise taxes to pay for, number one, servicing the national debt. David Walker, who is the former Comptroller General of the federal government, stood before Congress in 2010 and said, hey, we got a huge problem. Social Security, Medicare, and Medicaid are unfunded to the tune of about 150 trillion. Larry Kotlikoff, very famous economist out of Boston University, later said that number is as high as 239 trillion, meaning we'd have to have $239 trillion sitting in a bank account today, earning treasury rates to be able to deliver on everything we promised for those three programs that we can't afford to deliver. So we've got these huge fiscal shortfalls, and we're marching into a future. David Walker was running around the country in 2010, hair on fire, saying we've got a problem. We've got these unfunded obligations. Well, guess what? The chickens haven't even really come home to roost on the unfunded obligations like Social Security, Medicare, Medicaid, and we've already added another $24 trillion to the national debt since 2010. And the real spending hasn't even really begun. So recently, Penn Wharton came out with a study. I'm starting to quote this all the time because it's really creates a sense of urgency. They basically said that if we don't dramatically raise taxes or dramatically cut spending or some combination of the two by 2043, we will hit 200% debt to GDP. And when a country hits 200% debt to GDP, no amount of tax raising or spending cutting will arrest the collapse of your financial collapse of your nation at that point. So in other words, we've got to really get our house in order between now and 2043. I'm looking more like 2030 to 2032 is when tax rates are going to rise dramatically. And so what that means more or less is I believe that we have another 8 or so years during which to enjoy historically low tax rates.
Correct.
So if you are one of the millions of Americans who has 95% of your wealth squirreled away in tax-deferred accounts like 401ks and IRAs, what should you be doing
Yeah.
between now and then? And the point of my book, The Power of Zero, and other things that I've written is that there is absolutely something that you should be doing and something that you can be doing to help shield yourself against that eventual rise in tax rates. And I imagine we're going to be talking about some of those
Yeah.
things during this.
Yeah, we're going to hit on that pretty heavily. And I always tell people too that we know tax rates are going to change here in 2026. That's already built in. We know those tax laws are sunsetting. And so I talk a lot on this, David, about Roth conversions. We talk about a lot about Roth contributions. And I really want to hit home on this LIRP plan that you talk so much about and that we use inside of our planning. So I'm an advisor at Mutual of Omaha, CFP. I've heard you talk many times. I've read all your books. I love your podcast. You have an awesome YouTube channel as well. So it should be extremely clear to people that it's not just it's not Ed Slott saying this. It's not David McKnight saying this. It's not me preaching to my clients. It is a known fact that taxes are assumed to increase in the foreseeable future. It's a known fact.
No, yeah. There's no arguing that point. It used to be that people would, yeah, I read Dave's book, but he's too scandalous. He's too inflammatory. About he's a fearmonger on the potential for higher taxes in the future. And the truth is, I'm not. I mean, you're getting more and more experts that are coming over into my camp, and it's starting to get to the point where there's hardly anybody else. Even Susie Orman, for crying out loud, is saying, look, tax rates in the future are going to skyrocket. You should put your money in Roth and other types of tax-free accounts. Even Dave Ramsey, who I have often sparred with, is saying, look, don't do a 401k anymore. Do a Roth 401k. So more and more people, it's hardly anybody else that's saying you should be using these tax-deferred accounts. The question is, how should you use these tax-free accounts in concert one with another such that you can best prepare yourself for the impact of these higher taxes?
I love it. And I don't want to get political, but we just passed another spending package yesterday, foreign aid here in the United States, and our government clearly isn't stopping any of these spending habits that they have. So that's a problem. It hasn't been resolved. But let's talk about a solution. So the mission on your website, I love the mission on your website, and it's pretty tough to argue against this that it's a great thing. You want to put 100,000 Americans on the road to the 0% tax bracket in the next 10 years. That's your mission, which is an awesome mission. So it's not a hype word. It's not this 0% tax bracket. It's not just a sales tactic that people use to make sales of insurance products. Talk exactly about what is the Power of Zero plan? How does this implemented? And what is the simple basic structure of that you talk about inside of the book, David?
Yeah, so there's a couple of steps here. The first step begins with acknowledging that tax rates, even 10 years from now, are likely to be dramatically higher than they are today. That's the first step. If you're not willing to acknowledge that the math points overwhelmingly in that direction, then there's the steps that ensue don't really matter.
Yep.
So the first step is acknowledging the truth, and that's the tax rates have to rise. I mean, we can argue over how high, but they have to go up in the next 10 years, or it starts to get really, really difficult for our country to sort of get out of this tailspin from which it will eventually fall into. So once you acknowledge that tax rates are going up, the second thing you have to do is you have to acknowledge that in a rising tax rate environment, there's a perfect amount of money to have in each of your three buckets. Okay. And I identify these buckets in my book, The Power of Zero. The first bucket is a taxable bucket where every year you get to pay a tax. These are your emergency fund types of accounts, CDs, money markets, high yield savings accounts. You get the idea. I want to have about 6 months worth of basic living expenses in there. The second bucket is going to be your tax deferred bucket. These are the most popular accounts. Like I said before, 95% of the cumulative retirement savings of Americans across the country are in these types of accounts: 401ks, IRAs, 403bs, 457s, SEP simples. Believe it or not, in a rising tax rate environment, there's an ideal amount of money to have in there as well. And it's not zero, because you're going to have a standard deduction in retirement. So the ideal amount is really, you want to have a low enough balance that your required minimum distributions in retirement are equal to or less than your standard deduction, but also low enough that they don't cost Social Security taxation. So for a married couple, that's about $350,000. For single people, it's about half that amount. And then the tax-free bucket is going to be your Roth IRAs, Roth 401ks, Roth conversions, certain types of properly structured LIRPs or cash value life insurance. And then this next step is, once you acknowledge that there's an ideal balance in each of those first two buckets, the next step is to say, let's systematically reposition anything above and beyond those ideal amounts into your tax-free bucket. And you don't want to do it all in 1 year. You want to stretch that tax liability out. You want to shift the money slowly enough that you don't rise into a tax bracket that gives you heartburn, but you want to do it quickly enough that you get all the heavy lifting done before tax rates go up for good. And like I said, give yourself about 8 years to be able to pull that off. And so that's really, those are really the three steps. And the fourth step would be just make sure you're using a balanced, comprehensive approach to tax-free retirement. A balanced, comprehensive approach is going to include Roth IRAs, Roth 401ks, Roth conversions, taking money out of your IRAs up to your standard deduction, keeping your provisional income low enough so that your Social Security can be taxed. Did I say LIRP? And then if you can keep your provisional income low enough, then your Social Security is tax-free as well. So you've got basically 6 streams of tax-free income. You should have between 4 and 6 of those streams of tax-free income. And you can't accomplish that overnight. It takes some time to be able to pull that off. And so you got 8 years before tax rates go up. Don't let a single year go by where you're not taking advantage of these historically low tax rates.
This is awesome, David. And what I love so much about the Power of Zero plan is you're not saying, hey, let's use a cash value life insurance for all of your retirement savings. You're not saying, let's plow everything into a Roth account. You take an extremely balanced approach that's a tax efficient approach, saying we're going to have the taxable bucket. And then, yes, you're going to have some pre-tax retirement assets, but keep it under 350 so that you're getting the standard deduction minused out of there. You don't pay any taxes on that money. And then we're hitting the gold with the tax-free retirement income from the life insurance retirement plan and the Roth accounts. And what I love so much about this is it's not something that people have to wait to implement until they're 50, 60, or 70. I mean, shoot, David, people in their 30s and 40s need to start using this planning tool to say, hey, where is my money being shifted to? Do I need to start thinking about some Roth conversions in my 30s and 40s? Do I need to switch my pre-tax contributions at work to Roth accounts? It's a universal approach for anybody looking to save for retirement. Am I correct in saying that?
Yeah, I would say that the younger you are,
yes,
the more you should be considering tax-free accounts. If you look at the debt projection for our country over the next 50 years, we're going to put on $2 trillion per year of debt for the next 10 years. And that's not even really getting into the heart of the Social Security, Medicare, Medicaid problem. Okay. That's just paying for the things that are in the budget that don't include those 3 things. So by the time we hit 2034, the debt starts to go to $3 trillion per year. And so consider, if you're retiring in the mid to late 2030s or even the 2040s, think of what the debt's going to be. Think of what it's going to cost to service all that debt. If interest rates stay at historically normal levels like they are right now, or they go even higher, think of the cost of servicing all that debt. And by the way, the more debt your country has, the higher interest rates are likely to go, because people are going to stop loaning you money because they don't think you have the ability to pay it back. So they're going to charge you a premium for all that. So interest rates are going to go up. So the cost of servicing is just going to keep going up and up and up. So if you believe that your tax bracket is going to be lower in retirement than it is today, just take a look at the numbers and sort of take stock of what the fiscal trajectory of our nation really is, and then make your decision accordingly. But I tell people, the younger you are, the more you should take a hard look at all of the Roth accounts, cash value life insurance, so on and so forth.
Thank you. Thank you. Let's get into now, look before you LIRP. Let's talk about that. So I just interviewed Tom Hegna a couple weeks ago here, and he was telling me how his current retirement mix is like 30% cash value life insurance, 30% annuities, and then he's got 40% stock. So before we talk about look before you LIRP and some of the 8 questions to ask, what you look for, how distributions work from those cash value policies, let me ask you this question. Say I'm a 35-year-old person saving 25% of my gross income. David, what do you think an appropriate amount is to look at to put into a life insurance retirement plan of that 25%?
I'm on Tom's side with this one. I'm also on, and it basically confirms a study out of Ernst & Young that talked about using life insurance as a volatility buffer, or what I call a volatility shield. And basically the concept, pretty simple concept. Most people, if you follow what's called the 4% rule, that's sort of the most common way to mitigate longevity risk, or this idea that you could run out of money before you run out of life. The 4% rule says, hey, if you only take 4% out of your $1 million portfolio, for example, $40,000 that first year, $40,000 adjusted for inflation the second year, so on and so forth for your entire retirement, you got a pretty high likelihood, pretty high success rate that you won't run out of money before you run out of life. But that's a pretty expensive way to go about mitigating longevity risk. And Dave Ramsey is real big on this. This is why Dave Ramsey says take out 8%, because 8% inspires people with hope. Because instead of having to save 2 million, you only have to save 1 million to be able to get that $80,000 per year lifestyle. But let's say you got $1 million, you're living by the 4% rule. It's a pretty expensive way to go about mitigating longevity risk. However, according to Ernst & Young and Tom and me and a number of other experts, including Wade Pfau, they talk about this volatility buffer concept. And basically the concept is this: if you can accumulate at least 3 years worth of living expenses in your cash value life insurance, and we can talk about why cash value life insurance is the only tool that allows you to do what I'm about to describe, but accumulate 3 years worth of living expenses in your cash value life insurance. And by the time you reach retirement, it's got to be in place by day one of retirement. Doesn't work if you sort of fly by the seat of your pants afterwards. Got to be in place by day one of retirement. And then every time your market goes down, every time your stock market portfolio goes down, or in the year following when the stock market portfolio goes down, you pay for your living expenses out of your cash value life insurance. And that gives your stock market portfolio a chance to recover before you take further distributions. Now, what does the math tell us about this approach? Well, it's pretty extraordinary. The math tells us, and I've got calculators that I built that bear this out, and I've done hundreds of thousands of Monte Carlo simulations that bear all this out.
Yep.
If you do what I just described, your sustainable withdrawal rate on your stock portfolio goes from 4% up to 8% with a 95% success rate. So how do you pull all of this off? Well, I wrote a book called The Volatility Shield, and I showed pretty clearly that the protagonist of the story, took 30% of his retirement savings and put it towards a cash value life insurance policy, kept investing everything else in the stock market. And by the time he hit retirement, he was able to take a full 8% sustainable withdrawal rate on his stock market portfolio. And that was able to bridge his retirement shortfall. And so, gosh, I'm going to have another book coming out after the one that's coming out in the fall, where I basically address just sort of Power Zero 101. How do you save for retirement? I'm telling all of the younger generation, anybody who's 50 or less, 50 years or younger, put 30% of your retirement savings towards cash value life insurance, and that'll double your sustainable withdrawal rate in retirement.
I love it. I love it. So that somebody saving 25%, you'd say put around 8% or so into a cash value accumulation product.
Right. That's exactly
I love
right.
it. And that's a great bond alternative for people in retirement income time. Less risk, there's no downside, tax efficient. It's awesome. So talk to me about Look Before You LIRP. I loved that book. It's a great resource for people to check out. What are the 8 things that people need to look for if they're doing this life insurance retirement plan, where they're putting money into a cash value life insurance product that we're designing for lifetime tax-free income for retirement? What do people need to look for in that product?
Well, you're really putting me to the test here. I got to remember all 8 of those things. I don't know if I can crank out all 8 of those, but I'll see if I can basically describe the general premise of the book.
Please.
Basically, what I was trying to do is I was to say, look, people, LIRPs or cash value life insurance only really works if you keep it for your entire life.
Yep.
It's like getting married. In fact, on the cover of that book, you'll notice that there's a couple of wedding rings. In fact, I go through the whole first chapter and I explain in vivid detail exactly why starting a life insurance policy is like getting married. And I tell this to groups full of people. I said, how many of you guys had a laundry list of things you were looking for when you were looking for a spouse? And nobody raises their hand at first. I'm like, come on, you had a laundry list, right? And finally they raise their hands. I'll say, what are the things you were looking for? I want to be attracted to her. Maybe we're going in the same direction. Maybe we're belonging to the same church, whatever. I said, that's exactly right. You had a laundry list of things you were looking for in a spouse because you didn't want to get 10 years into it and realize, we got nothing in common. This isn't really working because divorce is painful, what have you. It is surprising and breathtaking how close a parallel cash value life insurance is to getting married.
Yeah.
Marriage doesn't really work all that well unless it's till death do you part. And cash value life insurance will be the worst investment you ever made if you don't keep it until death do you part. Therefore, the entire premise of the book is, if cash value life insurance is like getting married, then you should have a laundry list of things you're looking for when you're considering an IUL. You shouldn't just do it because the guy across the table from you gives you the warm fuzzies or is charismatic or what have you. You should do your research. You don't want to have any surprises. You don't want to have any bugaboos. You don't want to have any skeletons in the closet that arrive right when you need to take the money out, for example. And so I'll give you a couple of those things that I think are absolutely important to have. Number one is you have to have the ability to take a tax-free, which everyone's able to do, tax-free loan, tax-free distribution, but also a cost-free distribution. In other words, how do you take money out of a life insurance policy by way in a tax-free way? Well, basically what you're doing is you're taking a loan and you're using the cash value of the life insurance to collateralize that loan. So just in very, very simple terms, what you do is you call up the company and say, look, I want to take a $100,000 loan, and they won't actually loan you your own money. What they'll do is they'll take $100,000 out of your growth account. They'll put it in what I call a loan collateral account, and they'll say, okay, we're going to tell you that that's going to grow at 3%. And then they will cut you a check out of their own coffers, and they'll call that a loan. So it's an arm's length transaction with the IRS. And they'll say, we're going to charge you 3%. And as long as that 3% number that they're charging you never changes, and as long as that 3% number that they're crediting you never changes, the net result is it's a cost-free distribution from your life insurance policy. Now, I like it. Not all companies do this. I like it when they guarantee the 3% credit and 3% charge. Not all companies do that. If you can get that, that's great. Not necessary, but you want to be able to have a net 0% loan. You want it to be tax-free, which all loans are, but also cost-free. So that's probably the single greatest thing that I talk about having, is the ability to be able to take these tax-free, cost-free loans. I also talk about not all 0% loans are created equal. Some companies charge you interest in advance. In other words, they say, we're going to charge you interest up front as opposed to interest in arrears. That doesn't seem like a big deal, but when you amortize the effect of that over a lifetime, it can end up adding another 40 basis points to your loan, which, and people say, what's the big deal about having a net positive loan? Like, what's the big deal about 1% or 2%? Well, guess what? At the end of the year, if you don't pay that loan back, then that interest will be subtracted from your cash value, and that interest continues to grow and compound over the life of the policy. And a 2% loan could end up bankrupting your policy about 18 years faster than you thought. A 1% loan could bankrupt your policy about 11 years faster. So you don't want to horse around with this. And this is why I say, you want to do your due diligence when it comes to these life insurance policies. You don't want to figure out 20 years into it when you're planning on taking money out that you have a 1% or 2% loan. It's got to be a 0% loan. And you got to do enough legwork at the outset to ensure that that's the type of loan provision that's in your policy. And in my book, Look Before You LIRP, I go through and I show you how to identify a really lousy loan provision, and I show you how to identify a really good loan provision so that people have a guide as far as that goes. So one other thing that really bugs me about some life insurance companies is they'll, particularly when it comes to the IUL, the IUL, you're linking the growth of your money to the upward movement of a stock market index up to a cap. And if you ever lose money, if the index ever goes down in any given year, they simply credit you a 0. Some companies will suck you in with this idea of a high cap, so maybe 13 or 14%. And then once they have you in their clutches, they start to lower it year over year over year. So you want to have a company that has a track record of not just starting you with high caps, but keeping you at high caps. And because, I've seen companies, I've seen the illustrations, I've seen the enforced illustrations that show what happens to your policy if they keep reducing that cap rate over time. So that's another thing that I would say really watch out for. Do your due diligence. See what types of track records these companies have, because remember, it's a 60-year proposition for a lot of people.
Yeah, it's a long
And
time.
not all policies are created equal.
Yeah. So essentially what the life insurance retirement plan is you're putting the maximum premium in that the IRS allows us. So it's not a modified endowment contract, a MEC contract. So high premium, low death benefit. We're designing it for cash value growth. And then we're going to access that cash value growth via loans in the future, preferably the no cost loans like you just talked about. And then the idea is that that's a great bond alternative for your retirement plan so that you don't sell stocks when your stock portfolio is down. You sell stocks when the stock portfolio is up. And if the stocks are down, guess what we do? Take it from the life insurance, right?
Exactly. That's exactly right.
So I'm curious, what's your opinion on the index loans that people can utilize from IUL, Index Universal Life Products? What's your opinion on those?
I think those are good, particularly early on in retirement. They get to be a little problematic later on in retirement. I've seen some of these loan balances in some of these policies where you might have $3 million of outstanding loans, and you only have, say, $400,000 of cash to sustain those loans. Those loans can get pretty big over time. So I just would hate to be in a position where if you don't have growth in a given year and you got $3 million worth of loans and they're charging you 5% because you get the greater, it's the greater of.
Yeah.
So you don't want to be in a position where you're being charged 5% on a $3 million loan, and it's being that cost is being offset by the $500,000. Now all of a sudden you can go into a death spiral from which your policy never recovers, and then you get that phantom tax bill before you die. You'd be better off never having done the policy. So generally early on in retirement, I'm okay using those loans. Where it's a particularly good time to use those loans is the year after a down year in the stock market. Why? Because what happens to the stock market after it goes down? It typically goes back up. And those are the best. If you could predict every year when the stock market was going to go up, then you would know perfectly when to use the variable loan. Well, you can't do that, but you can get pretty close, because most years when the stock market goes down, it's followed by a year in which the stock market goes up. So if you wanted to play this perfectly, you'd say, okay, I'm going to maybe do my variable loan in the year following a down year in the market, and maybe the fixed loan in the other years. I'd say you could be a little bit more aggressive with the variable loans early in retirement and then play it a little bit more safe later in retirement.
I love it. Awesome stuff. So it should be clear that, we're not preaching put all of your money in cash value life insurance like some of the TikTok videos that are out of there. We're saying, hey, take a balanced approach. Let's take 8% of your retirement savings, for example, and put into this cash value life insurance product. But there's still a lot of advisors, national talking heads that say cash value life insurance is trash, it's junk. You pay these high commissions, it doesn't do what it needs to do. But talk a little bit, if you will, about the cost associated with these contracts when we're married to them for such a long time. But then also, it's a double-edged sword. If I pass away, my wife gets a tax-free death benefit from the life insurance today and in the future. I can use it for nursing home costs in the future, the tax-free income in the future, but there is a cost associated to it. Can you educate people a little bit more about the cost with these contracts and how that works?
Yeah, and you talk about the talking heads who don't like
Yeah.
life insurance. And I've actually got a book called The Guru Gap: How America's Financial Gurus Are Leading You Astray and how to get back on track. And one of the chapters is about cash value life insurance and what they say about it.
Yes.
What they say is that, for example, Dave Ramsey says 100% of cash value sucks 100% of the time.
Yeah.
Right.
Yeah.
Susie Orman says, if anybody ever tries to talk to you about cash value life insurance as an investment, you are to never work with that person ever again. Clark Howard says it's a steaming hot pile of garbage. Okay. What do all these people know that we don't? Or what is it that we know that they don't, right? Well, we just described a mathematically proven way to use, and here's the ironic part. Dave Ramsey is trying to get everybody in the world to take 8% distributions on their retirement because it inspires them with hope.
Yeah.
Yet he rejects one of the few means by which people can actually take 8% distributions on their retirement, which is through cash value life insurance. And the reason why they take this approach is, there's a couple reasons. Number one, they have to dispense one size fits all financial planning advice that appeals to the masses, and everybody's got to be able to look at what they say and make sense of it and see, wow, he's speaking to me, it applies to my situation. You can't do that with life insurance and annuities because they're just it's not one size fits all. And you can't say, hey, it works in A, B, and C scenarios, but not D, E, and F scenarios. That leads people to believe, gosh, maybe I need an independent advisor who can help me with this and not Dave Ramsey. So they have to make it sound like their one size fits all advice is good for everybody. Okay. So that's the first reason why I would say they uniformly reject cash value life insurance. The second thing they do is they fixate on the expenses of cash value life insurance in the early years of the program. Now, the thing that people need to know is that the expenses in cash value life insurance are front loaded. And this is how I explain it. I say the expenses are going to be higher in the early years, but much lower in the later years. But when you average it out over the life of the program, it should cost you about 0.5% of your cash value per year. That's pretty competitive when you compare it to what you might be paying in your 401k, for example.
That's what it is.
Now, you got to keep the policy for quite a long time, maybe 25 or 30 years before that average internal expense gets to that point. But I just finished explaining how don't start this policy unless you're planning on keeping it till death do you part. It only really works. So if this is like a financial marriage and you're planning on keeping this thing for the rest of your life, we really shouldn't be fixating on what the expenses are in those first 5 years. It doesn't matter. It only matters what the average expenses are per year over the life of the program. And that's like saying don't ever buy a house because the mortgage, in the first year, 95% of your money is going to go towards interest. None of it's going towards principal. And then projecting that out over the life of the mortgage, right? It just doesn't make sense. And it's the thing about the cash value life insurance is it's actually much, much more favorable than that amortization graph on the house. It gets much better, much quicker. And so I think that they have to have these sound bites that appeal to these aphorisms, if you will, that appeal to a broad, band of America. And they just can't capture the nuance of these types of programs in these short little sound bites.
Yeah, no, it's kind of honestly sad sometimes when that blanket advice gets out there because a lot of people it's stuck in their memory and they're thinking that, hey, so and so said this is not something we should do, so I'm not even going to entertain the idea. I mean, you've talked about it before how using an IUL as a cash value strategy increases your sustainable withdrawal rate at retirement time. It is an excellent tool that people need to be considering for their retirement income. So I do have a question along with the cash value. Say we have clients that maybe their health is an issue. One of the clients, it's a married couple. I've done it before, and I think far too many people think that if both of us can't have this as a tool, nobody should be using it. But it's appropriate, in my opinion, to use it on one spouse and not the other if we're doing a planning case. Would you agree with that scenario?
Yeah, no doubt. I mean, if it's good for one of the spouses, it's good for both of the spouses. If it's good for both of the spouses, it can also be good for one of the spouses, right? So there's no rule, there's no financial rule in the universe that says if both spouses can't take advantage of it, then nobody should take advantage of it. So you get what the insurance company is willing to give you. And unfortunately, not everybody's going to live forever. I tell people, I describe it in simple terms. When they rate you, there's like 30 different ratings they can give you. 1, 2, 3 means you walk on water, you're going to live forever. If you get the 30th rating, it's like they're holding out a mirror to see if you fog it. And then you could get everywhere in between. You got to be much closer to the 1 than you are to the 30. And not everybody is going to qualify, right? If you think of your life insurance policy as a bucket of money with a spigot coming out of the side of it, and that's going to pay for the administrative fees and the insurance, term insurance, annual renewable term. You start getting close to that 30th rating, those drops, it's like your money goes in and it comes right out. It's those drops get pretty expensive. And so it's not for everybody. And so we tell people that up front. So it definitely is appropriate if the husband, for example, doesn't qualify, the wife does, and it's okay putting on her. The one thing I do like to talk about is just the long-term care benefit on these policies. What do people hate about traditional long-term care insurance? They pay for 30 years, die peaceful in their sleep, never having used it. And they don't send you your money back at the end. It goes to pay for someone else's benefits, someone else's long-term care. And that can be a source of heartburn for a lot of different people. The way these policies are structured these days is if you can no longer perform 2 of 6 activities of daily living, you can find one doctor to write one letter to that effect. They will start sending you 2% of your death benefit per month for 4 years. For the purpose of paying for long-term care. Now, if it's what's called a chronic illness rider, they may discount that benefit based on the age in which you receive the benefit. But the point is this, they're willing to give you your death benefit in advance of your death for the purpose of paying for long-term care. And if you die peaceful in your sleep 30 years from now, never having needed long-term care, guess what? Someone's still getting a death benefit, probably
Yeah.
your kids or your grandkids. So there isn't that sensation of having paid for something you hope you never have to use. So this is a real, in fact, Wall Street Journal has talked about these types of hybrid policies. This is the new way that
Yes.
Americans have completely rejected traditional long-term care insurance. They've just rejected it. And so most are using these hybrid type policies to be able to
Yeah.
pay for long-term care. You have access to the cash, you can take money out tax-free. And if you die peaceful in your sleep, never having needed long-term care, all that money goes to your heirs. And that's a very attractive way to mitigate what is essentially a pretty grave threat during the course of a 30-year retirement.
Yeah, I mean, there's a high likelihood that if husband and wife live into their 70s that we're going to have a long-term care claim. And I tell clients all the time, this life insurance, again, double-edged sword. Use it for your own benefit while you're alive for the nursing home, or give it to your kids income tax-free when you pass away. So I know we've covered a lot of stuff today. It should be clear to people now that a life insurance retirement plan is something for you to consider with a portion of your assets, not all of them. Can you touch quickly at the end here, because I know we're running up on your time. Can you touch quickly about tax-free income for life and how people can utilize annuities to take advantage of those tax-free income for life accounts, and why now might be a good example to look at something like that with rates as high as they are, David?
Right. So we've talked about longevity risk. We've talked about one way to mitigate longevity risk or to increase the withdrawal rate on your portfolios through life insurance. But there's only one real way to completely purge longevity risk from your portfolio, and that's by way of an annuity. Okay, an annuity, basically what you're doing, I know that's a 4-letter word for a lot of people, but if you don't like annuity, you're not going to like Social Security, and you're definitely not going to like that company pension that you're planning on receiving, because they all operate by the exact same principles. It's a risk pooling concept. Okay, so you hand money over to an insurance company in exchange for a guarantee that you will always be getting a stream of income so long as you're on this side of the grass. Now, if the name of the game is simply to make sure that your money lasts as long as you do, we've already discussed that the 4% rule is the most expensive way to go about doing that. If you need $80,000 per year, you're going to have to save $2 million. Okay. And that's why Dave Ramsey rails against the 4% rule. He says it just robs people of hope. So if you have an annuity, particularly with these high interest rates today, you can now say, okay, I'm going to hand a chunk of my liquid stock portfolio over to an insurance company. In exchange, I can get $80,000 per year, adjusted for inflation, every year for the rest of my life. And guess what? It doesn't cost $2 million to get that stream of income. It costs substantially less. So if the name of the game is to not outlive your money, you can get that $80,000 adjusted for inflation for substantially less than the $2 million. It might be closer to, say, 1.3, right?
Yeah.
Now all of a sudden you got 700,000 left over, and you can do some interesting things with that 700,000. You can take care of your long-term care needs with an LIRP on you and an LIRP on your spouse. You can put the rest of that money into your stock portfolio and grow it in a pedal to the metal sort of a way, because now your living expenses are guaranteed by Social Security, maybe a company pension, and maybe that annuity. So that gives that becomes your discretionary account to pay for things like the hole in the roof or the trip around the world, or you want to take the kids to Disney World or what have you. And so so two things that the annuity does that nothing else can do. It allows you to spend more money, and it gives you a guarantee that your money will last as long as you do. Nothing else in the world, not even Ken Fisher's stock portfolios, can do that. But nothing else can do that except for an annuity. So that's why all of these reports, all of these studies that are coming out from Ernst & Young to BlackRock, everywhere you look, people are talking about the benefits of annuities. 30% into an annuity, 30% into life insurance, and the balance going into your stock portfolio.
Yeah, that is awesome. I always tell people you may hate the word annuities, but you won't hate the guaranteed paycheck that you get for the rest of your life.
No, indeed.
I mean, that is just the deal. Hey, real quick too. So there's always talk. Some people, hate Roth accounts, hate Roth deferrals because they say, hey, government's going to change them. But the balance in Roth accounts from a national standpoint is extremely low, right?
Yeah, it's about 5% of the cumulative retirement balances across the nation.
And so for me, it's like the government's a lion, it's getting attacked by hyenas. it's not going to care about the fly on its butt that's the Roth account, right? I mean, what's your
Right.
opinions on that?
Yeah. So not only is there not a very big target on Roth because there's frankly not very many of them,
Yeah,
but you have to remember the Roth IRAs are the one thing the federal government likes and everyday citizens like you and me like. Why? Because federal government loves it because it gives them more revenue today. Because remember, it's after
right.
tax dollars, and we love it because it shields us from the inevitable rise in taxes over time. And so there's not that many things in the world where both the government loves it and we love it. So I don't anticipate that the federal government is going to be getting rid of the Roth anytime soon. I think it's here to stay. Um, if ever they were to change something, it would probably be a grandfather sort of a thing. Whatever money
Yep.
you do have in Roth, you get to keep in Roth. It continues to grow tax free, but you just can't put any more contributions in there. But again, why would they do that? That gives them more revenue today. And politicians are always about what will give us more revenue today. Whenever they have these new spending bills coming out, if they need to bridge some sort of shortfall or plug some hole in that budget, what do they always do? They beef up the Roth,
Yeah,
the Roth
yeah,
offering somehow, or they require you to put a match into the Roth portion of the account
correct.
because that gives them more tax revenue today.
Which we can do now, which is awesome for some plans to take advantage of that, for people to take advantage of the Roth employer contributions into their plan. Last question, I swear, and then I'll let you go, David. So right now I'm using an IUL for my life insurance retirement plan, but David McKnight, would you rather be using IULs or VULs for this life insurance retirement plan, and why? Real quick.
I've got VULs on me, my wife, and all my kids, but that was also a function of me having bought these 20 years ago.
Okay.
Um, I love taking advantage of the stock market growth. I will be rolling these over into IULs
Okay.
at some point. Why? Because VULs don't work very well as volatility buffers in retirement.
Correct.
You
Correct.
can't shield yourself from volatility with an account that's exposed to volatility.
Yep.
And so at some point in time, I'll be rolling all those accounts. I'll probably leave the VULs on my kids because they got plenty of time to let
Correct.
their money grow and compound over time. It's, if the market goes down, they have time to watch it recover. But my VUL, my wife's VUL will be rolling over to IULs. Generally, the line of demarcation is about 50. If you're over age 50, IUL looks really, really good. Um, so um, so I would say I do have VULs right now, but probably it's just a question of having procrastinated a little bit before I roll those over into IULs. Because really, if you're going to use it as a volatility buffer, you can't be using money that's exposed to volatility.
Yeah, I love that strategy. VUL early, maybe buy a term so you guarantee your insurability, and switch to IUL later in life. I love that. That was an awesome takeaway for me. Well, David, this has been awesome. Thanks so much for your time. I know you're a very busy guy. Everybody, I'll link all of his websites, video. I'll link your YouTube page on there, which is awesome. Any closing thoughts that you have for us, David, before you take off?
No, I would just say, look, we're at a very unique period in time where tax rates are historically low. Don't let that lull you into a false sense of security because things are starting to accelerate and we're starting to see the handwriting on the wall. So just take advantage, particularly before 2026, but even between 2026 and 2030 or 2032, take advantage of those historically low tax rates because once tax rates go up, they're never coming back down.
Yeah, have a plan. It's very important that I think people work with an advisor, from doing distributions, using an IUL in retirement. It's very important that you have somebody that has their hands around tax environment, policy changes, investment changes. It's very important to have a trusted advisor you're working with. So, David, I will let you go because I'm going to read about 5 minutes of disclosures here to make the compliance guys happy. So, thanks so much for your time. I really appreciate it. Look forward to seeing you soon.
Thanks. My pleasure.
Take care. No tax or legal advice is being offered. Securities offered through Mutual of Omaha Investor Services, Inc., a registered broker-dealer. Advisory services offered through Mutual of Omaha Investor Services, a registered investment advisory firm. David, you can sign off if you want. I'll finish these disclosures. I won't pain you. Thank
Okay.
you.
Thanks so much, man. Great interview.
Take care. Great to meet you.
Yeah. Bye.
Trading instructions sent via email will not be accepted. Please call 402-379-6745 or Mutual of Omaha Investor Services, Inc. at 800-228-2499 for all buy-sell orders. Please note that communications regarding trades in your account are for informational purposes only. You should continue to rely on confirmations and statements received from the custodian for all of your assets. Investing involves risk, including the possible loss of principal. Past performance does not guarantee future results. Diversification does not guarantee a profit or protection against a loss in a declining market. Purchase of life insurance is not subject to meeting underwriting requirements. There's no guarantee an individual will be insurable. Annuities are long-term investments designed for retirement purposes. Withdrawals of taxable amounts are subject to income tax. Anything taken prior to age 59 and a half, 10% penalty may apply. Guarantees are backed by the claims payability of the insurer and are subject to their terms and conditions. This podcast is for educational purposes only and may include references to concepts that have legal and/or tax implications. It is not to be construed as legal or tax advice. Such information or opinions is subject to change without notice and is not intended as an offer or solicitation with any respect to the purchase or sale of any individual security, insurance products, or offer of individual investment advice. Any strategies discussed may not be suitable for everyone. Mutual of Omaha Investor Services Inc. does not provide tax or legal advice. Please consult with the appropriate professional regarding your personal situation prior to making any financial decisions. Securities and advisory services offered through Mutual of Omaha Investor Services Inc., member FINRA, SIPC. Riser Insurance is not affiliated with Mutual of Omaha Investor Services.